Good afternoon, everyone. Thank you for joining us today. We are going to be presenting the webinar for tax year end planning for landlords. My name's Mitch Young, co-founder of the Fusion Consulting Group, and we're delighted to bring you the next webinar in our series, which is great timing, being that there's only 25 days left until the start of a new tax year. So hopefully you'll get some good value, some good information that you can action heading into the new tax year. I'm joined by my colleague today, Henry Smith Langridge. So you'll hear from him shortly. And also, if you do have any specific questions for us today, then please feel free to email us. You'll see our email addresses dotted along the screen throughout today's webinar. Appreciate when we're talking about taxation, some things may be personal of nature, so please feel free to reach out. And as always, we're offering a free consultation to anyone who's listened to today's webinar. So please feel free to reach out and you can have a meeting with Henry. Today's agenda, so we're likely going to be speaking for around about 40 minutes, and then we'll conclude with some questions towards the end. If you do have any burning questions that pop into your mind as we're speaking about a specific subject, there is a chat button that you'll see on your screen, and you can type any questions you like, and if it's relevant we may address that question as we're speaking, and if not we will come to them towards the end of today's session. So the theme is around landlords and property. Henry's going to cover over a lot of the compliance elements. I'm going to talk on the structuring and tax planning, and then we'll conclude with some questions. Make sure that you do engage with us. We're here to help. We thank you for your time, and hopefully you enjoy this session today. So I'm going to hand over to Henry, who will start the next part of today's presentation.
Thank you, Mitch, and hello, everyone. Good afternoon. I hope everyone is doing well. And before we get started, I thought just start by saying landlords and property ownership in the UK has been one of the most hot topics of the last couple of years. And I suppose for a lot of people, they don't necessarily even understand how expensive it can be to invest in real estate into the UK. So we're going to go over some of the compliance, maybe dispel some of the myths that are associated with property ownership in the UK and landlords. And I hope everyone is ready to talk about tax. So start by saying, from a compliance setting, self-assessment is, hopefully everyone's already aware of what that is. That's filing tax returns in the UK. We need to be mindful of capital versus revenue expenditure. These are just some of the topics which we'll cover in presentation today. HMRC have increasing powers when it comes to not just exercising their taxing rights on property, but also information exchange. So pretty much every property in the UK right now with land registry, HMRC know about. So if you exchange a property, if you sell a property, buy a property, HMRC are going to know about it. And of course, making tax digital, which is something that's constantly talked about in the media. So the first question, do I need to file a tax return? So there's a bit of a misunderstanding about who needs to file one. But if you're a landlord not even in the UK, if you're just a landlord, invest in UK residential property, and you have rental income in excess of £1,000 a year, you're going to have to file a tax return. That if you're a part owner, let's say you and your spouse own 50-50 share of a UK rental property, and your share is in excess of £1,000, you're going to have to file a tax return, even if there's no tax to pay. And I think that's a common misconception. You know, I oftentimes people ask me, I've incurred huge losses on my property. Do I need to file a tax return? Well, if the income's more than £1,000, you certainly do. So tax reporting, but specifically when it comes to self-assessment, we're not really looking at tax due. We're just looking at reporting requirements. And if you owe tax, you will pay it through self-assessment, but it's your opportunity to disclose, and it's your legal duty as a landlord in the UK, regardless of where you live in the world, to report that you have income from a rental property in the UK. So it could be quite challenging because some people have owned properties for a number of years, maybe if they've been empty, vacant, or they've been your previous home. We still need to consider what the filing requirements are going to be for those landlords. One of my favorite tax planning opportunities, which I thought I'll touch on in this presentation, is about jointly owned properties. So landlords in the UK, if you are in it, this is specifically for maybe people who are married, but even if you're not married, this is still the case. If you own a land title deed in a joint tenancy arrangement, ordinarily income and expenses are split 50-50, and each individual will have to file a tax return. However, married couples in the UK can transfer assets and property to each other under the no gain, no loss principles, and they can transfer properties over to their spouse. And let's say you're in a situation where one spouse is a higher rate taxpayer, the other spouse is a basic rate taxpayer. It wouldn't make sense for the higher rate taxpayer to be paying their marginal rate of tax on the rental profits. And instead, what would probably make more sense is splitting the income in accordance with whatever ratio you desire. So oftentimes this looks like 99% to one spouse and 1% to the other. So let's say you own a property. Currently, it's being taxed 50-50 between two spouses. A brilliant piece of tax planning is to split the income and expenses in accordance with the higher tax-paying spouse paying a lower amount of tax on their profits, and for the lower paying tax-paying spouse to be paying tax on their profits. So the idea is you're reducing your overall tax exposure across. For that's married couples, of course, if you're, let's say, in a joint tenancy agreement with your siblings or your parents, you can also make this election, but we need to bear in mind that you cannot transfer ownership between third parties or connected parties without a tax consequence. CGT reporting as well. So even if, let's say, you own a property in the UK and you rent it out, UK and non-UK residents have 60 days to report capital gain and pay any CGT due. So, 60 days isn't a long time. And what's more is that, let's say you reinvested the proceeds from a property sale into another property purchase or a down payment for another property, HMRC now want their tax upfront, and they kind of want the before you're in a position where you could spend the money, they're going to want their tax. So 60 days is not a lot of time. So let's say you completed on your sale and you haven't consulted a tax advisor. Bear in mind as well that conveyancers and solicitors, whilst they can do the stamp duty returns, don't always necessarily take responsibility for doing the capital gains tax return. So don't just assume your estate agent is going to, or your conveyancer is going to sort out your capital gains tax return. It's your legal responsibility to, as the owner of a property in the UK, to ensure that the capital gains tax return is filed. So this only applies for UK residents, for people selling UK residential property. So it doesn't matter if you're living in, say, Hong Kong and you own UK residential property. This applies to every single property transaction within the UK's borders. So if you're offshore or if you're not in the UK and you sell UK property, you still have 60 days to pay the tax. And bear in mind, the capital gains tax on immovable property in the UK, such as residential property, is still payable in the UK, regardless of where you live in the world. Of course, you still get principal private residence relief. So if you live in the property, let's say you sell your main home that you've lived in for your whole period of ownership, then you can exempt the gain from capital gains tax. You don't need to file a capital gains tax return if you're claiming full exemption under principal private residence relief. However, if there's a period of absence, or if you, let's say, lived in the property and then left it for a few years and you didn't rent it out, that doesn't mean the full principal private residence relief is going to apply. So bear in mind, principal private residence relief isn't always assumed to exempt the whole gain. So reach out to a tax advisor and get them to look at it, because again, if you fail to make the tax payment by 60 days after you sell your property, of course, you're going to incur things like penalties and fines and things like that. So this is only to do, just to clarify, this is only to do with UK residential property. So if you say own a property in France and you sell it, you don't have to report it to HMRC, even if you're a taxpayer in the UK within 60 days. You still, of course, have to figure out what your reporting position for self-assessment is, but the 60-day rule only applies for UK property. Let's say for whatever reason, and it does happen, people don't necessarily know what their reporting requirements are. If you've forgotten or you didn't know you needed to report, again, some of this, you could own a property for 20 plus years. HMRC might not ever ask the question about, is this landlord filing a tax return? Let's say you haven't. There are processes to come clean to HMRC. Of course, we assist our clients with regularizing their tax affairs and making sure that they have a clean slate and they've represented themselves to HMRC. Of course, you'll need to go back in time and dig up all of the records in relation to that property. But let's say you never filed a self-assessment tax return and you owned a piece of property in London and you're renting it out and making a profit and you've never reported it. Come speak to us. We can help you get that up to date with HMRC. So one of the benefits of having this sort of process with HMRC is you get reduced penalties. There's no statutory penalties. And as well, it means you can't be prosecuted for fraud. However, there is still going to be a 90-day deadline. So once you notified HMRC of your intention to come clean, you have 90 days to do so. So again, that's something we help our clients with all the time. Now over to Mitch, who's going to talk a bit more about tax planning and a bit more of high-level tax opportunities, savings opportunities in relation to landlord and property ownership in the UK. Over to you.
Yeah, thanks, Henry. Thanks for that. Really good. So it's now the time where we talk about a piece of tax planning, particularly with landlords. It's important, for anyone that owns property, it's important to look at, are they operating in the most tax efficient manner? Are they, can they save tax today, but also have one eye on the future from a legacy perspective? As we know, property is one of those asset classes that interact with all the relevant taxes: income tax, corporate tax, capital gains tax, IHT, and sometimes VAT as well. So it's important that you consider all your options. And one of the things we do on a regular basis is we write tax advice. We write agile pieces of advice for our clients that look at, okay, this is your current tax exposure. Here's option A. This is a tax impact, option B, C, D, etc. And one of the major things that we look at is involved around people who own property as individual landlords, or they own property in joint names and they're paying higher rate income tax. And what happens, as we know, is that you can't have the availability to offset the full amount of mortgage interest. So it becomes very inefficient to own rental property in individual names when you're at the higher rate or additional rate of tax, because essentially you can only deduct the 20% of the mortgage interest as a tax reducer, and the rest is taxed at the higher rate on profits which aren't actually true profits. So what can be done in this type of scenario? So we look at can you move the properties into a limited company? So why would you move your properties into a limited company? Generally speaking, one of the benefits is that you can offset the full amount of mortgage interest in it once the properties are in the name of the limited company, and then pay tax at a true profit rate at 19%. We're currently 19%. It's increasing next in April to 25% on profits above 250k. So that is why a lot of landlords are looking at moving things from their own name into a limited company, or indeed, as they purchase more properties, sheltering that within a limited company. However, moving the properties from your name into a limited company creates a taxable event. Typically, there's capital gains tax to pay and stamp duty potentially. Capital gains tax is calculated on what you originally paid for the property, less the market value at the date in which you move it into the limited company. Now, when you have a number of properties, and when you can say that your property portfolio is your main business, then you can potentially claim what's called incorporation relief. Incorporation relief is essentially a capital gains tax relief. Is when you have an unincorporated business and then you move it into an incorporated business, hence a limited company, and in those scenarios you don't have to pay capital gains tax, and you essentially roll over the gain into the cost of the shares. So we look at the sort of what HMRC look at as the characteristics of what is a business. And it all stems around, can your property portfolio be classified as a business, and are you running it as a business? You look at things like the number of hours in which you're spending on that business. You're looking at, is it making a profit? Are you and your partners essentially following the basic business principles? There's no essentially black and white. This is a guidance. Case law has shown us it will look at significant number of hours per week, per month, in terms of your time spent on that. So for instance, if you were employed and you had managing agents looking after your properties, it might be hard to argue that you would qualify for incorporation relief. But essentially, this is something that we analyze, and for professional landlords, portfolio landlords, it could be likely that if they own the properties in their name, they want to move it into a limited company, then potentially they could qualify for this capital gains tax relief. Then we look at, so that's one method of sort of tax planning that one could look at. We then look at partnerships. So Henry touched on the fact if you own properties in joint names, or if you're husband and wife, can you create different ownership percentages? Can you move things into the spouse's name perhaps? But we look at essentially establishing formal partnerships. So this is where you own the properties in joint names, and essentially what we'll do is we will set up a legal document called a partnership agreement, and then get that registered with HMRC. Now, one of the major benefits of establishing a partnership is that it could give you good agility in the future to safeguard tax reliefs. So, for example, if it made commercial sense to move your partnership into a company, then incorporating a partnership is the only place in the tax legislation whereby you can mitigate stamp duty. So you could end up with a scenario where you've run your partnership for a period of time on a commercial basis. You then look at moving that into a company, and that could be a way, in the right circumstances, where you could potentially mitigate stamp duty, land tax, and corporation and capital gains tax on that transaction, and that then you can operate your property portfolio in a limited company, and that should be nice and efficient. There is anti-avoidance on this, as you would imagine, as the legislation came in, as the mortgage interest rules came in. a lot of people were looking at this type of planning. So what HMRC said is that they wanted to stop people just establishing a partnership day one and incorporating day two. So they've put in anti-avoidance so that you have to run the partnership for a minimum of 3 years, 3 complete tax years, and then you can incorporate on the right basis. Some of the other structures that one may consider or one may seem is, similar to a partnership. You can have different types of partnerships. The partnership I just described is a normal traditional type of partnership, but then you can have a mixed use partnership, such as a limited liability partnership. And again, this will be all part of the foundation planning of what suits you, your family, your business. Mixed use partnerships come around whereby you can essentially look at having a management company, perhaps in and around your property portfolio as well. So that is where that may come in. And then we look at what's called family investment companies. So this is something that we're doing on a fairly regular basis, whereby we're looking at establishing a whole structure for a family. And essentially the family investment company will govern the whole structure. So the family investment company is the top company. It essentially is a limited company governed by shareholders agreements, governed by articles of association. It will have specific classes of shares for the parents, for the children, and more recently we're adopting some trust work within the shares from a legacy protection point of view, an inheritance tax point of view. And the idea is you utilize the family as shareholders. It will give you good options in terms of dividend distributions for the children for the trust. And then underneath that, it owns the other entities, and then you can flow monies round in a tax efficient manner. In an ideal world, the parents subscribe for the shares via a loan, so it's a continuous use of repaying the loan, which is tax-free, and obviously legacy planning as well. So this is something that if you are looking at restructuring, it's worth considering that type of structure as well. Obviously, the idea is that the whole growth of the portfolio moving forward will sit outside the estate because the children own the shares day one, and then obviously any income gains, etc., is all being sheltered at corporation tax rates. Just one thing to note that often doesn't get talked about, the ATED, which is the annual tax on envelope dwellings. This is where you own residential property within essentially a limited company, and it's valued at above £500,000. There is additional compliance to be aware of, so that will be in the form of a tax return every April. If you own residential property that is not being rented on a commercial basis, and either your family or connected parties are living there, then there'd be an annual tax charge to pay. So just bear that in mind. Often clients that are in that situation might not realize about the compliance duties on that. So there is a bit of tidying up work to be done. So really, as mentioned, there's a lot that can be done. There's a lot of options in regards to tax planning and property. Essentially, what you need to do is you need to analyze all your options and see what suits you. Obviously, tax is just one element of the decision-making process. So that is why we don't just silo on one single option. But, this tax year, we're in March. If you are thinking about planning and structuring, the capital gains tax allowance is £12,300. As of April, that is being slashed in half, as is the dividend allowance. So any planning really, particularly involve property, gifting of assets, selling of assets, you should seriously consider thinking about doing this month. And of course, if you want to chat to us, have a consultation to see how we can help, we'll be delighted to hear from you. So please feel free to reach out. You have all our details. I think we've got some time for some questions. So I'll invite Henry back on. If you do have questions, please put them in the chat. We'll hang around for a minute or so just to see if there are any questions. Otherwise, the recording will be sent round to everyone today. So if you want to check back and listen to some facts that we've done, that's fine, and then contact us. But do feel free, if you do have questions, to post them in the chat bar, and we'd happily answer to them. Okay, all right. Well, look, we appreciate everyone's time today. Hopefully you got some good value, some good thought-provoking content there. And please feel free to reach out if you would like to chat to us ahead of the new tax year. So thanks everyone for our time. Look out for our marketing for the next series of webinars heading into the new tax year. We've got the budget coming out next week, so look out for our guides on that, which will be sent out. And Henry, thanks for your words of wisdom as well.
Yeah, I see there's a last minute question there, Paul. Paul, 3 years is the anti-avoidance guidance. Of course, I would suggest if you have questions about that, please reach out to us so we can talk more about that. But 3 years is the minimum according to the anti-avoidance legislation. But thanks for that question, Paul.
Yeah, maybe that, at the time of which you were advised, that might just be the best sort of process in which, accountants or advisors were recommending. But yeah, as Henry said, the avoidance is the avoidance. So
wow, everyone's coming with these last minute questions. Natasha, property owned by a limited company, do you still pay 60 days fast CGT? So companies do not pay capital gains tax, they pay corporation tax. So a company selling a property, so the capital gains tax reporting, they will not need to do the 60 days, but they will need to, for the company, they'll need to pay the corporation tax on the profits and things like that. So it's a bit different there. Wow.
You just thought you were going to get away with lunch there, didn't you?
I did. Higher rate taxpayer, properties my name only. How do I? So you're married, which means you can transfer assets such as property to your wife, and there'll be no tax implications with that. So let's say you had 100% ownership of a property. You could do a transfer. It's a straightforward legal process to move the ownership from your name into a joint tenancy agreement with your wife. And then you do something called a Form 17 to do a declaration of beneficial interest in the property, and then we'll move over the profits into your wife's lower tax band. So it's a very straightforward thing to do, but my suggestion is reach out to us and we'll explain how the process works in more detail. But it's a very solid, and HMRC, this is a very low-hanging fruit in terms of tax planning, because of course spouses benefit from being kind of taxed in a very flexible manner when it comes to matrimonial assets. Those great questions there.
Okay, all right. Well, yeah, thanks everyone. And yeah, we will see you at the next webinar.
Thank you, everyone. Thanks, Mitch. Take care.
Bye.